Good day, everyone. Today, we're diving into the world of tokenization of real-world assets. This is the process where physical things, like real estate or gold, get transformed into digital tokens on a blockchain. Imagine, instead of dealing with paperwork and banks, you have a digital certificate that you can split, trade, and access 24/7. This is a key part of the Web3 revolution, making assets accessible to everyone, not just the wealthy elite. According to recent McKinsey reports, the tokenized asset market could grow to between $2 trillion and $4 trillion by 2030, excluding cryptocurrencies like Bitcoin. Why does this matter? Tokenization cuts costs, boosts liquidity, and ensures transparency through blockchain's immutable ledger. No more waiting for business hours or paying hefty fees to intermediaries. Everything happens instantly and securely. In a world where traditional finance is slow and exclusive, tokenization democratizes investment, allowing fractional ownership where you can buy a tiny slice of a luxury property or a bond for as little as $50. It's already reshaping industries, from finance to art, and with advancements in blockchain tech like Ethereum upgrades, it's only accelerating. But don't worry if you're new to this, we'll break it down step by step, covering the basics, the process, pros, cons, and real examples. By the end, you'll understand why experts are calling this the next big shift in global economics. Let's get started. Tokenization is essentially creating a digital twin of a real-world asset on a blockchain. At its core, a token is a unique code or digital representation stored on an unchangeable distributed ledger, ensuring no one can tamper with ownership records. There are two main types: fungible tokens, which are interchangeable like stablecoins, think USDC, pegged to the dollar, and non-fungible tokens, NFTs, which are unique and one of a kind, perfect for items like artwork or collectibles. The process breaks down into 4 key steps. First, sourcing. You select the asset to tokenize. This could be anything from real estate to commodities, but you must consider regulations, things like securities laws in your country. For instance, in the US, the SEC oversees tokenized securities to protect investors. Second, issuance. This is where the magic happens. You create the token on a blockchain platform like Ethereum or Solana. Smart contracts, self-executing code, handle the rules, automating things like dividend payments or transfers. Tools like ERC's 20 standards for fungible tokens or ERC 721 for NFTs make this straightforward. Third, distribution. Once issued, tokens are stored in digital wallets and can be traded on decentralized exchanges, DEXs, like Uniswap or centralized ones like Binance. This opens up global markets, where anyone with an internet connection can participate. Fourth, servicing. Ongoing management includes updates, compliance reporting, and handling redemptions if someone wants to convert the token back to the physical asset. The advantages are huge. Round-the-clock access means no more market closures, you can trade anytime. Fractional ownership lets you divide a $1 million property into 10,000 tokens, making high-value investments affordable for everyday people. It slashes intermediaries, brokers, lawyers, banks, reducing fees by up to 90% in some cases. Transparency is baked in. Every transaction is verifiable on the blockchain, minimizing fraud. Plus, it enhances liquidity. Illiquid assets like art or private equity, which might take months to sell traditionally, can now be traded in seconds. But it's not all smooth sailing. There are downsides to consider. Regulatory barriers are a big one. Governments are still catching up. For example, in the EU, MiCA regulations provide a framework, but in other regions, unclear rules can lead to legal headaches. Volatility is another issue. If the underlying blockchain, like Ethereum, experiences price swings, it can affect token values, even if the asset itself is stable. Security risks, such as hacking smart contracts, have led to losses in the past. Remember the Ronin bridge hack? That's why audits and insurance are crucial. Adoption is growing, but scalability remains a challenge. Blockchains can get congested, driving up fees during peak times. Solutions like Layer 2 networks, e.g., Polygon, are helping, but we're not there yet. A prime example is BlackRock's tokenized funds. Their BUIDL fund, a tokenized money market fund, has surged past $2 billion in assets under management as of 2025, showing institutional interest. It's backed by cash and treasuries, offering yields while being tradable on-chain. This isn't just hype. Firms like JPMorgan and Goldman Sachs are experimenting too, with pilots in tokenized bonds and equities. Overall, tokenization bridges traditional finance, TradFi, and decentralized finance, DeFi, creating hybrid models that could unlock trillions in value. As we move forward, interoperability between chains will be key, allowing seamless transfers across platforms. Let's look at real-world cases to make this concrete. In real estate tokenization, platforms like Realty are leading the way. They allow you to buy fractional shares in US rental properties starting at just $50. As of recent updates, Realty has tokenized over 200 properties worth more than $45 million, generating passive income through rent payments distributed via tokens. Investors get weekly payouts in stablecoins, all automated by smart contracts, no need for property management hassles. In the art world, NFTs have exploded. Take Beeple, his digital artwork Every Days, the first 5,000 days sold as an NFT for a record $69.3 million at Christie's in 2021. This wasn't just a sale, it proved how tokenization can verify provenance and enable resale royalties automatically. Artists now earn ongoing percentages from secondary sales, something rare in traditional art markets. Challenges persist, though. Regulatory hurdles are evolving. In December 2025, the US SEC granted a no-action letter to DTCC, allowing tokenization services for stocks and bonds on approved blockchains for 3 years. This is a big win, but compliance is still mandatory. Firms must ensure tokens aren't treated as unregistered securities. For beginners, starting small is key. Try stablecoins like USDC on platforms like Coinbase to get a feel for wallets and trading. Watch out for scams. Always verify projects through audits from firms like Certic. Scalability and environmental concerns, blockchain energy use, are improving with proof-of-stake transitions, but they're not solved yet. Tokenization is transforming finance, making it more democratic and efficient for everyone. From real estate fractions to tokenized treasuries, it's the future of asset management. Keep an eye on trends like multi-chain integration and AI-driven compliance. If you're excited, subscribe for more content on blockchain innovations. Drop your questions in the comments below, and let's discuss how you can get started today.